everybody, and welcome back. If you're new to the channel, my name is Nick, and at 42, I quit my job and I live life on my own terms. I am the author of the Quick Start Guide to Investing, and I support my family of four with a dividends portfolio, which we're going to talk about today, and weekly options trades. In today's video, it's been a highly requested one. People are wanting an update on what's going on with my dividends, why I'm investing in certain things, and what I'm doing. So grab a cup of coffee, hit that like button, and let's talk about my dividend portfolio. In the past month, I've dropped 2 of my holdings and I've added 2 to my watch list. I try to keep around a 10% per year portfolio, but because of my additional Bitcoin exposure, which we'll talk about here in a second, it's going to be a little bit higher. So stick around to the end and we'll find out just how high. Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. Let's get into it. Before we get into specifics, for those of you who may be new to dividend investing, let me give you a quick rundown. The dividend portfolio is essentially a collection of stocks and ETFs that pay out regular dividend profits to shareholders. These payouts, called dividends or distributions, can be a fantastic source of passive income. My portfolio focuses on high income, diversified approach, mixing in growth and income. All right, now we've covered that. Let's get into the portfolio. I'll give you a brief overview of each holding, talk about the dividend, what it looks like, and why I'm holding it. So first up, Vici Properties. It's a fascinating real estate investment trust company, also known as a REIT. They own huge destination properties, things that you've seen in Vegas. They own all the big boys. Yeah, that one, and that one, and that one. Yes, all the ones you're thinking of, they probably own it. Not Circus Circus. Actually, they might. I don't even know if they own Circus Circus. The point is, Vici Properties trading at 31.41 right now. They're up 6% year to date. They're down 4% on the 1 year. Their current dividend yield is 5.76%. I think I got in at a little bit better price, so I think I'm about 6.3%. They have a history of consistent dividend growth, which is something that I look for. I love Vici for its stability of income backed by long-term leases with major gaming companies. They have what's called a super lease. Okay, it's not really called a super lease. It is net 3, which means that the gaming people, the casino owners, they own all the money that they're stealing from you, but they don't own the buildings, but they do have to pay all the operational expenses. So as operational expenses go up, that's cool. Vici doesn't care. That just means that the casinos have to pay Vici more money. So I like Vici, and I think Vici is going to continue to grow. All right, next on the list, ARCC. Let's pull them up. Ares Capital is a BDC. They're trading at $20 per share. And if you don't know, a business development company is a lot like a REIT. These companies, they lend money to middle market companies, often providing debt or equity financing. And they're structured like a REIT. They pay a significant portion of their income to the shareholders, which gives them a favorable tax status. So they've got an impressive yield. It's around 9.62%. Year to date, they're currently at a buying opportunity. You can see that they're down 8.4% and down 6.5% on the 1 year. Again, with a dividend yield of 9.62. A lot of people are a little bit nervous about what the Fed's going to do because typically BDCs are pretty yield sensitive. So as the yields get cut, people are wondering, will BDCs lose some of that prominent cash flow that they've had? But ARCC is one of the best in the business. I think that they will be stable even as rates drop. I think ARCC is going to be doing very well. So I actually might be adding into ARCC if they drop any more. The next holding on my list is a closed-end fund, and the ticker symbol is ADX, Adams Diversified Equity Fund. It's one of the oldest closed-end funds around, having operating for more than 100 years. Yeah, 100 years. And ADX typically pays quarterly dividends like a variable rate. And they've changed that this year. They used to have like one huge payment towards the end of the year and kind of some smaller payments throughout the year. Now they're trying to stabilize that. So if you look at like this, we're at TradingView, it says the dividend yield's only 4.94. That's not true. They're mixing some of the small from last year without contributing the big one. What it's going to be is basically a 10% dividend each year. Year-to-date performance, they're up 12.87, 6% on the 1 year. But look at this all-time number, 9.64. What else does about 9.64% over the last 100 years? Oh yeah, the stock market, the S&P 500. They say if you get between 8 and 10%, you're doing pretty well. Well, ADX is giving you 9.64% plus a dividend. Right now, that dividend is about 10% per year. So ADX over the last 100 years is actually outperforming. I mean, the S&P is not that old, but it's outperforming the S&P 500. So they are looking for growth as well as income, and I love that. And I like ADX in my portfolio for that very reason. Now we're going to jump into the next holding of mine, some of the newer high income strategies. And this one is from SPYI from NEOS. And this is an S&P 500 that sells call options. So you're getting exposure to the S&P 500 and you're getting a solid annual dividend rate. So currently they're trading at $52 per share. Their year to date is only up 2.91%. I actually bought them at the first Trump kind of dip when he announced the tariffs in April. Everything went down. I put 10 or 20,000, I think it was $10,000 into SPYI at the time. So my year to date is a lot better than what this is showing. But anyway, I'm not bragging, just buy the dip. Always have cash on the sidelines. When something crazy happens and you like a certain stock, be ready to buy the dip. But you look at here, the dividend yield is 11.79%, which is very good. If they can capture half the upside of the S&P 500 and give you an 11.79% dividend, that is what I'm looking for in my current state of affairs. So I like it. And similarly to this one is the cousin from NEOS, QQQI. So QQQI covers the NASDAQ 100. And it's going to employ a very similar cover call option strategy, holding the underlying like Apple and Microsoft and Amazon. Then they're going to generate option income on that. The current price is $54 per share. They're up 4.3% year to date, 7% on the 1 year. But look at this dividend yield, 13.6%. So this gives me high yield exposure to the over-oriented, tech-heavy NASDAQ 100. I like that a lot. And there's actually one on my watch list that we're going to talk about here in just a second that either might replace QQQI or be a very aggressive kind of next in the mix. Speaking of aggressive, the next two that round out my portfolio are pretty dang aggressive. And one of them probably wasn't all that great of a decision. Let's start with that one. Misty, MSTY from YieldMax. It's the MSTR option income, and MSTR is already very volatile. It's kind of crazy. So YieldMax, Misty, is doing synthetic covered call strategy on MicroStrategy stock, which is already a leveraged position on Bitcoin. They're trying to get you huge distributions. When I first bought the fund, it was like 150%, but things fluctuate quite a bit. As you can see, they're down about 56% year to date. Bitcoin isn't making the huge move that I think myself and a lot of other people thought was going to happen, as well as Misty just kind of gets chewed up a little bit. So look at this dividend yield. It says 426%, but that's not right. They just talked about, they being YieldMax, talked about changing their distribution frequency from 28 days to 7 days, which is confusing a lot of the calculations. But what they're shooting for is just a small little 80% annualized yield. Finally, let's talk about my last holding. It's very similar to Misty, except for it's based just on Bitcoin, BITO from ProShares. It's trading at around $18 per share. It's down about 23% year to date. And this is the first ETF to provide exposure to Bitcoin futures contracts in the US market. Its dividend is highly variable and it's designed to on a rolling yield strategy. Basically, you're going to end up with about 50%. Right now, it's showing 56%. That's about what I've been getting. So I've got a couple $1,000s in BITO. I'm getting a couple $100 a month. So things are going pretty well. I like BITO. I like the exposure to Bitcoin. If I could drop one of them, I would definitely get rid of Misty and I would keep BITO because I think it's a little bit more of a common sense approach and you don't have as much NAV erosion, even though YieldMax doesn't like the word NAV erosion. I don't know what else to call it because Bitcoin's not down 50%. MicroStrategy is not down 50%. But Misty is, so whatever. Anyway, let's get to the two that I've dropped. So this month, I dropped two different stocks. I dropped TLT, which is the iShares 20-year Treasury Bond ETF. It's trading at $91 per share. My strategy behind getting in that was it was stable, right? It's only 3% yield, but it was a lower price last year when I got in, thinking that as the Fed started cutting rates, it was going to go from the 90s to the 95, 96, 97. But when we look at the 1 year chart, it's not. It's negative 0.8%. We haven't seen that huge boost. I know the Fed's just started cutting, but typically when the Fed starts cutting, you see the yield curve invert. and we're not seeing the kind of move that I wanted to see in TLT. So I sold the $30,000 that I had in TLT. That was only getting me 3% dividend yield, and I got rid of it. The next one I got rid of might be a little bit controversial, the Schwab US Dividend ETF SCHD. I like SCHD. I've made a video how it's a great piece in the average for the 3-fund portfolio. I'm not backing away that call. I think if you don't need to live full-time on the income, SCHD could still be a great position in a 3-fund portfolio. But I am living basically full-time on my options trades and my dividends. So I need more than the 3.83% that I was getting, as well as I needed more of the growth. So I cut the position of SCHD, and I'm looking at these next 2 funds that hopefully might make more of an impact into my portfolio. The first fund on my watch list is UTF, and it's a closed-end utility fund. Much like I was thinking with nuclear stocks on a video I posted a few weeks ago, the demand for AI power is going to be huge, and so is infrastructure. So let's look at UTF. UTF is the Cohens and Steers Infrastructure Fund. It's currently $24 and it has a NAV of 25. So you're getting about 90 cents off of NAV right now, which is going to help you with the yield. It's year to date, it's only up 0.6%. 3 years up 3.3. So you're not going to see a ton of growth, but if they can capture some of that AI growth in the infrastructure build out, it'll be solid, as well as a 7.72% dividend yield. And you're getting 90 cents under NAV right now. So you're getting a stronger dividend yield than you would historically get from a fund like this. So 7% on a pretty stable fund seems like a good choice, but not as good, not as crazy, not as fun as the next one I'm looking at, FEPI. Let's pull it up. FEPI, the Rex Fang Innovation Equity. These names are all so loud. Why do you have to name these things so many huge giant names? Let's just call it FEPI. FEPI is the premium income fund. Again, you can see it's trading at $48.59 right now. Year to date, it's down, so it could be a buying opportunity. Basically, what they're trying to do is they're holding 17 FANG stocks, if you remember FANG before the Mag 7. But they're giving a dividend yield here, if you look at this, 25%. And they're doing basically a covered call strategy on these stocks. You're looking at Micron, Intel, AMD, Apple, Tesla, Meta, Alphabet, Amazon, Microsoft, NVIDIA, and 7 other stocks. So you got 17 small basket of stocks that somebody's kind of micromanaging, and they're really trying to squeeze out using options to get you a 25% play. So it's a little bit like QQQI, focused on heavy tech holdings, but instead of 100 some companies, it's only those 17. And I like what they're trying to do. So maybe when Bitcoin kind of hits the peak before the bear market, I will sell some of my Bitcoin stuff and I will get into FEPI. So that is not it for today's portfolio, because I just remembered that I want to talk about results. So when you add up all those 7 positions, I have $107,000 invested. I'm averaging $1,790 per month, $1,790 per month, which is $21,480 per year. So you take $21,480 per year, you divide that by $107,000. That means that my current dividend portfolio is averaging 19.94% right now. Take that, Johnson & Johnson. And if you didn't get that joke, you're probably not a dividend investor, because Johnson & Johnson historically is a dividend. Anyway, it doesn't matter. Anyway, tell me right now, what are your favorite holdings? Not in my portfolio. I mean, you can tell me that as well, but what are the favorites in your portfolio? Hit me in the comments below. Don't forget to hit that like button. If you would, subscribe. That way you're going to get more portfolio updates, general investing, and money content. Thanks for watching, and I'll see you in the next one. Thanks for joining me today on 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.